Sebastian, for those of you that don't know me, one of the directors of the Climate Energy Finance Group, and I'm here to introduce our speaker for a CEF Group and Sense of Sustainability joint seminar and webinar. So hi to you online. So we've got today Lucas Kengmana from the New Zealand Super Fund, who is who's part of the sustainable finance team there, developing the sustainable investment approaches of the New Zealand Super Fund. And so he's going to talk to us about that today. Thanks, Lucas.
Thanks, Sebastian. And I'm very happy to be here. Cool. So this is just a very, very rough agenda. I've got about 40 slides. There's probably very little chance of me getting through all 40 today. So I'm very happy to take guidance from anyone. If anyone wants me to dive into anything in further depth, please just jump in and let me know. But sort of what I was planning to do is spend 5 to 10 minutes giving a little bit of an overview of the New Zealand Super Fund, who we are, what we do. Then I wanted to talk about this project that we've been working on for the last roughly 3 years. We kind of gave it the grandiose name, Reviewing the Responsible Investment Compass, but in simple terms, it's really just a review of our responsible investment strategy. I'm going to talk about a couple of tangible things we did there. So what we did to enhance our reference portfolio, and I'll tell you what a reference portfolio is, and more recently, what we've done to enhance one of our strategies, our specific investment strategies, called our multi-factor strategy. And then I'll talk about our impact investing. And then I thought I'd close with some thoughts about sharing a little bit about where we think we're going, what's next for us, and then also some big questions we're facing, with the hopes of maybe sparking some discussion about how that relates to what's happening in academia and potentially how we can work together in the future to address these things. So diving into an overview of the New Zealand Super Fund. One of the challenges at this time of year is we've got our new financial results. So these are about a year old, but we can't quite share them yet because we want to save them for our annual report. So unfortunately, these numbers are slightly out of date. But maybe starting with who the New Zealand Super Fund is. We are a fund set up by the government, basically dealing with the issue of the demographic shift that New Zealand was facing back in 2002. So basically at the time, the bulk of the baby boomers were in the workforce, which meant that there was a cyclical surplus in the tax revenues. There were more people working than retired. Over the subsequent 20 years, we've seen more and more of those baby boomers exit the workforce and move into retirement. And we are going to continue to see a similar demographic shift, so more and more retirees continuing throughout most of the decade. And so the government kind of had a couple of choices. They could either raise taxes in the future, cut spending in the future, or they could transfer some of the money that they were earning in 2002 to future periods. And thankfully, from my perspective at least, they decided to do the latter. And so they've been putting aside money for the last 20 years into an investment fund, which the Guardians, which is where I'm from, manages on their behalf. We are, because we are receiving funding for the next 10 or so years, and we will continue to grow until at least 2080, mostly off the back of investment returns. We take a long-term perspective. There's no need to return the capital in the short run, so we're quite a growth-oriented investor. the fund has returned relative to just a passive set of investments. Moving to the next slide. So in terms of how we invest, we've been given a mandate by the government. And so a mandate is basically how the government expects us to invest. They expect us to invest in a prudent commercial manner. And they want us to implement best practice portfolio management, maximize returns without taking any undue risks, and avoid damaging the reputation of New Zealand in the world community. We have a set of endowments, so we kind of think of these as our competitive advantages, things that not a lot of other investors have, and they allow us to invest in certain ways. So one is our long time horizon. Most people can't invest, with a view out to 2080 and beyond. A second thing is operational independence. The government doesn't interfere with what we invest in. Third is our sovereign status. So sometimes being a sovereign wealth fund comes with a set of advantages. Some certain investees like to have us on their book. And then we think we've got a pretty good governance system in place. So having strong governance allows us to make some decisions that would be challenging for some others. In terms of where we invest, we, for the most part, invest pretty similar to how the world as a whole invests. I think the key differences are we have more, significantly more invested in New Zealand than the world portfolio would suggest we should, and similarly a significantly larger proportion invested in Australia. Is that? Okay. Cool. Sorry about that. Cool. In terms of what we invest in a range of different things: global equities, debt, alternative investments, hedge funds, catastrophe bonds, those types of things. Private equity, so those are businesses that are not listed. Land, so farms and forests. Infrastructure and real estate. And then this is just a breakdown of where we invest in New Zealand. I'm just going to skip over that relatively quickly, but you're welcome to refer back to that. I think that the key thing here is probably that we have a fairly large allocation to timber and coal in New Zealand. That just reflects New Zealand's economy. And then, just in terms of our performance, the three lines there, the blue line reflects what the money would have been worth if they just paid off debt or invested in government bonds. The orange line or gold line reflects the returns that would have been delivered if the money had been invested in just passive indices, and the black line is the performance we actually delivered. Okay, so now getting into the real meat of the presentation, the review of the responsible investment compass. So as I say, that's kind of our grandiose way of saying our review of how we do responsible investment. We've actually been doing responsible investment for many years. I mean, arguably since we were set up, we've been looking at this stuff. But we've continued to evolve our approach over time. Don't expect you to be able to read all of that off of the slide, but again, the slides will be available afterwards. I mean, it's just really the point of this is just to say that we've consistently been involving what we do over time. So what motivated the review of the responsible investment compass was we started to notice a few emerging challenges. So one, we had an independent review, so every 5 years, the Treasury commissions an independent review of the performance of the super fund, and they look at, it just provides a third-party view on how we're performing. We did pretty well in that review. I think pretty much most areas came through with sailing colors. I think on the responsible investment side, we also got a good rating, but what they did note was that the trends in place at the time meant that we were going to have to work hard to continue to stay on top of that because there was just so much evolution in the space coming through. We were also challenged in court for some of was actually the procurement practices of one of our portfolio companies. We ended up winning that court case, but it still took a significant amount of resource. So it just went to show that, there are practical implications for wanting to make sure that, your higher practices are very good. And then finally, we were facing increased media inquiry. So for a while there, it became one of the journalists' favorite activities was to go and look at what the controversy of the day or a company that had recently been in the spotlight, and they realized that we published all of the companies in our portfolio. There was about 8,000, 9,000 different names in there, and they would just go through that list and see if we owned any of those companies, and then they would send us through information requests, usually at about 3 p.m. on a Friday. So that was just taking up quite a lot of time and adding quite a lot of stress. But what often were quite 0.001% of our total holdings. So again, it just brought to light the fact that actually this stuff has real practical implications. So sorry, I've got my slides just slightly wrong. So we kicked off three RI Compass work streams. The first one was a look at ESG trends and stakeholder expectations. That was just sort of wanted to see, A, how is the world of ESG evolving, and B, how were our stakeholders' expectations of us changing? And I mean, I guess exponential growth and higher and higher expectations were basically the key themes that came out of that. We were seeing more and more data on ESG, more and more activity on ESG, and more stakeholder demand for good ESG practices. The second one looked at how do we define and deliver positive investments. So positive investments are kind of what we meant by positive investments are really that sort of best-in-class investments from an ESG perspective or from an impact perspective for things that could really make a positive impact on the world. And then, our key finding there was, look, we thought that we could do it, or at least we should give a very good try to doing it across our investment portfolios. We didn't need to go out and create a specific bucket to place those things in. We also began to develop a framework for defining what more formally what we meant by positive investment. And then the third work stream was the link between ESG and financial performance. So one of the objections we often face when we get asked to do something, to behave ethically, is that it might detract from returns, and we have a fiduciary duty to our stakeholders, or some kind of duty to our stakeholders to maximize financial returns because they're relying on us doing that. So we said, well, okay, fine, let's have a look and see whether there's a link, a negative link between these two. And then I'll just dig into that a little bit more. So the key findings there really were, and I'll just talk to the last one. We found a weak positive link rather than a negative between ESG and financial returns. And so what we mean by weakly positive is that we aren't able to rule out the possibility that there is no link. So we're saying it could be zero. but there is also some evidence that it could be positive. We did not see very much evidence that there was a negative. We actually looked at a few different sources for that. So, one, we looked at the academic evidence, and this is one of the academic studies that we found most influential, and it was a meta-study, so it looked at a significant number of papers that were published and their results. So what the figure on the left is showing is how corporates perform, so good ESG performance corporates. Was there a positive link between ESG performance and financial performance? And the majority found that there was. So that's what the purple bar says, and then the gray bar says, is there a link between good climate change performance and corporate performance? And that came to a similar conclusion. There's still quite a lot in the middle there, but either having a neutral impact or having a mixed impact. But as you can see, there's only somewhere between 8 and 6% that found where they found a negative impact. And the stuff on the right is a kind of a mirror for that, but it was looking at investment portfolios rather than individual companies. And I think the overall message is very similar. There's possibly just slightly less evidence for a positive link and more evidence for a neutral impact. But again, the negative results were quite small. So that was the academic evidence. We looked at practitioners' views, so we talked to a bunch of asset managers and also peer funds, and they echoed our sentiment for the most. There was obviously exceptions, but yeah, that's so based on all that evidence, we decided because we used it positively. And just turning to the so what, well, based on the fact that it was becoming best practice, based on the fact that there wasn't a trade-off in financial returns, we decided, the board decided to change or to introduce a sustainable finance goal and to move us from being a responsible investment-focused institution to a sustainable finance-focused institution. And now that kind of sounds like semantics, but I think there is actually quite a significant shift there. And the way we interpret that is we think that responsible investment is all about how environmental, social, and governance issues impact financial returns. Responsible investors say these do impact financial returns, and therefore, as a responsible investor, I will take them into account. Sustainable investors go a step further and say that is very true. And on top of that, we also think that investment portfolios have real-world environmental and social impacts, and we want to deliver positive environmental and social impacts. So that's that was sort of the implications of our shift. So given that the board had given us this new strategy, we then looked at how we would actually implement that in the fund. And where we started was actually with our reference portfolio. The reason we did that is our biggest strategy. It's already, and we were already running it against a bespoke low carbon methodology. Is everyone familiar with reference portfolio, or what a reference portfolio is, or shall I? Okay, I will go through what a reference portfolio is. So I guess in finance, there's most financial instruments you buy tend to go up over time. And so if you were to give me some money, you should expect me to give you some more money back. So you shouldn't say, okay, you handed me $10. If I give you $11 back, you shouldn't say, well, great result. You need to actually go and take into account, how much money you could have made if you hadn't given it to an investment manager. You just put it to work in the market. And there are ways of putting things to work in the market that are very cheap, that don't involve you having to go out and hire a lot of people. So the reference portfolio is designed to capture basically how the New Zealand government could invest its money if it didn't want to appoint a manager, appoint us as manager. What it is in practice is it's a set of index funds that look, that are a low cost way of achieving market returns. The other thing that's interesting about reference portfolios is actually how we invest our portfolio as a default. So we kind of start out with all of our money invested in index funds that mirror the reference portfolio, and we only move away when we think we can add value. So in finance, it's all about delivering excess returns on a risk-adjusted basis. So anytime we find something where we can get either more returns at a lower risk or the same returns but at a lower risk, we take those bets. And so that's how we deploy our portfolio. There's a section on passive portfolios, but I think passive portfolios are just a set of portfolios that are put together using a bunch of rules. So the NZX 50 is a classic example of a passive portfolio. That just says what are the 50 largest companies in New Zealand, and we'll just assume that you own a proportion, you invest your money equal to their market cap. So just if this one is 10% of the market cap of the index, you'll invest 10% in it. And they're popular in investment because they're cheap and easy. They give you a market return beating markets high. So before I dive into what we did with our passive, or how we shifted our reference portfolio, probably it's worth me just taking a second to talk through how you can enhance a passive portfolio. Now, this is a fairly simplistic enhancement of a reference portfolio. It's not actually what the portfolios we ended up landing in. The approach they take is more advanced, but I just wanted to give an example that doesn't require you to have a strong background in mathematics to understand, and it serves as, I think, a pretty good theoretical analog to what is actually happening. So this example is actually how we used to invest our reference portfolio. So what we did is we got a collection of global stocks based on a global index. So the global index just said, what are all the stocks out there? What are they all worth? And invest proportionally to that. We said, okay, yeah, great. And then we started to apply our climate methodology to it. The first thing we did is we said, we'll take out any company that owns any fossil fuel reserves. We didn't think that fossil fuel reserves were the fact that they were going to have to be phased out over time was being reflected in the price of these fossil fuel companies. So we said, look, we don't want to, on that basis, we don't want them. So, that was the first step. So going from A to B, we just knocked those out. And then from B to C, what we did is we removed the high emission stocks. And the way we did that, because it wasn't just a pure screen, take out anything that has these things, we made a list, and we started with the most carbon intensive stock at the top of the list, and just went down and wrote the names down according to the carbon intensity. Then we set a target. We said we wanted to get a 50% reduction in greenhouse gas emissions versus the starting point. And we just deleted the first company from the list. And then we checked our portfolio and said, does this meet our target? If the answer was no, then we went and deleted the next company on the list. And then we checked again, and we just kept doing that until we got the answer, yes, you've now achieved that 50% reduction. And the stocks that were left in there became our reference portfolio. So that's kind of, I guess, conceptually a way of thinking about how a ESG enhanced portfolio is constructed. So what do we actually do in shifting to this enhanced index? Well, we went out to the market and we asked different data index providers to pitch indexes to us. We told them the kinds of things we wanted to achieve in financial terms and in ESG terms, and said, look, send us a handful of your best indices, and we will compare them and select one. We'll select one. Best meets our needs. Just on a small technical point, one of the other things we needed to do was consider whether we do this through the reference portfolio or through whether this was a management step or whether it was a board decision. And so if it was a management step, potentially that was a decision that we were making to differ from the reference portfolio. In this case, we decided it was simply adjustment. So in terms of our financial criteria, we looked at a range of things about a range of different metrics. A lot of these were about not taking on excess risk. So there are a bunch of financial characteristics that add style risk to a portfolio, and we said, look, we don't want too many of them. There were other characteristics we looked at, like the number of securities held and the diversification of the portfolio. And these were important for so the number of securities was important because we wanted to try and reduce the number of companies in our portfolio, because that would allow us to become more familiar with each of the companies in our portfolio and avoid being exposed to so many different types of controversies. The other thing we were quite interested in was the predicted tracking area. The predicted tracking area is basically just a measure of risk. So we wanted to make sure that we weren't taking too much risk. Turning to ESG performance. So the way we did this assessment is we asked a bunch of different ESG data providers to give us a series of give us access to a series of their scores, and we then compared how the different indices perform. There's a lot of different data on there. I'm not going to go through it line by line, but I think I'll just talk about a few of the important ones. So ESG score. So an ESG score is a score a company gets based on a whole bunch of different metrics. Each of the different data providers applies a slightly different methodology, a slightly different algorithm to calculate a score. It's messy. There's not a lot of correlation between the different providers. I mean, in a way, you're trying to judge whether a company is good or not. So I guess that's not super surprising, but we thought it's still important to try and get an overall view of company performance rather than just purely always trying to look at individual metrics. ESG momentum is kind of, that sort of captures the fact that looks at whether a company is getting better or getting worse over time. And there's a little bit of evidence that there's persistence in ESG performance. So if a company puts its mind to becoming more sustainable, it tends to continue to become more sustainable rather than start to move in the opposite direction. Then we have revenue analysis. So there's a bunch of different revenues that are generally connected to either industries that are considered really good. So there on here we've got alternative energy, energy efficiency, major disease treatment, education, all sorts of quite good things you probably like your companies to be involved in, but also some negative ones. So gambling, weapons, fossil fuels. So, I mean, I guess the trick for reading this is all of this is color coded. So the green represents excellent and red represents bad, and so the colors in between different shades of performance. Yeah.
What are the columns?
The columns, yeah. So the columns, I had to type them out for the most part. So because these are the different indices we run them. I had to confidentialize the data because we only have permission to use the data of the indices that we selected. So that's the MSCI Paris Aligned Index, which is the one in red, and that's the one with the red circle around it. That's the one we chose. MSCI's ESG Enhanced Index is also there. And then there are indices from 5 other providers. So these are carbon metrics, so mostly scope 1 and 2 intensity, and some other there's fresh water on there, and then female represent to number of companies with 30%, at least with 30% representation, females on the board of directors. And then these are things related to controversy risks. So we've got a global focus list where we put companies we are concerned, whose behavior we're concerned about. So this was just a count of the number of companies whose behavior we found we were concerned with. Then there are companies involved in recent controversies. So we had a set of controversies we were aware of, and we just counted up the number of companies involved in them, and then companies on our exclusion list. This is a bit of a comparison of the financial returns of the different portfolios, and it's quite interesting because the column on the left is a market benchmark. The column immediately to the right is the index we selected, and what this data shows, and I won't walk through each of it, each of the metrics, but it pretty much shows universal outperformance for the ESG Enhanced Index. There's probably wouldn't want to read too much into that. As Sebastian pointed out in an earlier discussion we had, a lot of this is done on what I call back tests, so they're not actually an index up and running. It's how the index would have been invested if the index had existed at that time, and that does allow the person who's constructing the index to kind of potentially overfit if they want to. So they can make things look better than they probably would perform in real life. And then this is just this slide just shows how the different indices perform when the market's going up and when the market's going down. So on the x-axis, we've got down capture, and what that's saying is for every dollar the index moves down, how much does do each of these portfolios move down? And the nice thing here is all of the portfolios actually move down at a lower rate. So they actually, ESG indices seem to perform better in a higher risk environments or in downward environments. The y-axis shows how well the indices do when the market's going up. So a 1 would mean that the index, the ESG index moves up for $1 every time the comparator index moves up by $1. Unfortunately, none of them outperform, but none of them cross that line. Only one of them will cross that line. But nonetheless, the dotted line is the line that shows whether the index outperforms the benchmark of 100 performance, and you can see they're all outperforming. So, key takeaway here is they perform, most of these ESG enhanced indices perform better in the bad times. They perform slightly worse than the good times, but overall. And this is just how a Paris line benchmark, which is the benchmark that we selected, is constructed. So if you remember back to the example I gave at the start on how an ESG index is enhanced, we had 2 things there. There's a whole set of things that are enhanced now. So there's some overall ESG things, including exposure to controversies. There's some risk measurement or risk management metrics, so about reducing exposure to fossil fuels, to high carbon intensity, reducing the overall emissions in the index by 50%. There's investment in green solutions. There's alignment with 1.5 degrees, so that's saying are the companies that you're invested in aligned with, do they have 1.5 degrees targets in place? And there's a look at physical risk. So, as you can see, this is quite a big step up in terms of the ESG objectives relative to the way we used to manage money. So turning to that's the work we did the year before last, and on the back of that, we shifted our reference portfolio over to these ESG enhanced indices. Following on from that, we then started to look at our active portfolio and look at how we would change those. And we started with our multi-factor portfolios because they're also listed equity portfolios, and because they represent 19% of our total investments. So just quickly, what is a multi-factor portfolio? A multi-factor portfolio is a portfolio that is also constructed using a set of rules, but these set of rules are different from passive portfolios in that they are trying to align the portfolio with certain financial characteristics that have shown to outperform in the long run. So there's a bunch of academic literature out there that suggests that companies with certain financial characteristics have a tendency over the long run to outperform the market as a whole. There's a whole bunch of different factors that people think might add value, but there are four that tend to emerge quite often, and certainly the four that we lean on. So value, momentum, quality, and low volatility. So, we have a set of these portfolios that are invested on that basis. And we decided we wanted to look at what does this change to our reference portfolio and our objective to be more, to deliver social and environmental outcomes mean for how we should manage these portfolios. So, what we decided there ultimately was to change the benchmark of these indices to match our new benchmarks, so these new Paris-aligned portfolios. And what that basically does is that says, this is your base, this is your starting point. And if you want to move away from the starting point, you take on risk to do that. Perfectly fine, as long as you're being rewarded for that risk, but don't go. People are incentivized not to go and make changes unless they are. Keep being rewarded for it. What we found, though, is that limiting our managers just to that index would constrain them too much. They wouldn't be able to get the same level of exposure to value, low volatility, momentum, and quality as they previously were able to, because it was going from an index with I think 6,000 stocks to about 600 stocks. So what we said was, okay, we'll let you use a larger universe to select from. But nonetheless, there were still these, anytime they stepped outside of that benchmark, they were having to take on active risk. So they would only do that where they really needed it to achieve the financial exposures they were looking. And then the other question that we needed to figure out was what level of ambition should we set for these managers, and should we actually say, look, you must deliver the same portfolio targets that the Paris Aligned benchmark is delivering. Ultimately, we decided we should say that we should ask them to have the same level of ambition, so to take the Paris Aligned targets as a statement of our level of ambition, but not constrain them to delivering that based on MSCI's data, because we realized that they had their own data sets. There's some disagreement in data sets, and given that they were doing a lot of work on this, we didn't want to say you must do it in exactly the way we do it. So finally, turning to our impact investment plan. So as a reminder, this is basically how do we identify our best-in-class investments, how do we make more best-in-class investments, and how do we report on those investments we've made. And really, at this stage, what we've done is we've added a two-step process. The first step is impact checklist. It's a fairly simple checklist that we go through, and really we're looking for whether the investment is intentional. So does this investment have an intentional impact on ESG, and whether that's measurable. And so we go through a simple process. The reason why it's simple in the first instance is it allows us to put it into our due diligence investment process so that we can have that information when we make a decision on whether to proceed with due diligence and whether to proceed with the investment. We then go through a longer, more rigorous process where we actually say, oh, can we go and measure all of the 5 dimensions of impact? So the what, the who, how much, contribution, and risk. And we do that as a second stage, ideally before making an investment, but we do allow ourselves additional time where necessary. So in terms of what next, I am going to go through this very quickly because I want to give some time for questions. I mean, I guess we will continue to progress through the active portfolio and look at enhancing ESG through the rest of it. So we're currently looking at how we rate external managers, and how we send signals to them to enhance their ESG performance. And we will soon kick off a project on 2 projects, one on how to enhance the ESG performance of our fixed income portfolio, and then how to enhance the ESG performance of our hedge fund derivative type portfolios. So yeah, look, I was going to go quickly, just very quickly, and talk about sort of big questions that we're facing, and potentially, maybe these are opportunities for us to collaborate on some research. One is, how do we define good? So there's this issue with low correlation between ESG scores between different providers. Is there a way that we can, is there good academic evidence on ways to aggregate different scores or take data from different scores? And pointed me to some good papers on this before, Sebastian, but there's still some work in that space. Trade-offs, I think, we're really struggling as an industry to figure out what do we do when we have to make trade-offs. You compare a company that's having a great impact on on climate change, but terrible impact on pandas. I don't know. Yeah, and then I think more broadly in academia, like we're very conscious of systematic risk. So risks that impact the economy as a whole, particularly where there's strong externalities and the companies are behaving in one way because it's in their interest, but it's negative for the economy as a whole. We think our interests actually align better with economies as a whole, so we want to know if there's a way that we can advocate for strong policies. I think in climate change there clearly is, emissions trading scheme, strong policy, a bunch of other complementary policies. There's quite a good academic literature out there on it now, but there's probably less work on biodiversity and other issues. And then I guess theory and practice. So I guess that's sort of referring to the fact that look, there's been a huge wave of reporting demands that have come through recently. I think that for the most part is great, but it's creating a few issues. One, there's a big shortfall of sustainability expertise out there. So that's more about, can you train more students and send them to the market as soon as possible. But I think also, with great data comes great responsibility. Don't spoil Spider-Man, if we're creating data and no one's using it, it's very quickly there's going to very quickly be a reaction to that. And so, I think it's important for all of us to figure out how we're going to use it, all this new data quickly. And then this is something Sebastian and I were talking about just half an hour ago, is I guess there's a bit of a trade-off between consistency and relevance. So there's a lot of push for standardization for consistency, and I think that's really great. But one of the tricky things I think that potentially problems that potentially creates is sometimes if you go to a standard metric, it's not quite as relevant to you because it's not tailored for your industry. So I'm not sure, as I say, these are big questions, and I'm not sure that there's a specific answer that we can find for that, but I would love to know if there were, broader thoughts on that. So that's all I really had. Happy to open the floor to questions.
Yeah, we've got some online one of this. So, hey Manu. Manu Kelly asks, so does sustainable mean that investments will only fund truly sustainable activities, so industries and businesses that can continue in perpetuity because they don't rely on any non-renewable resources? Or does it mean just stuff that is a bit less destructive, extractive, including than some other equally unsustainable alternatives?
Yeah, that's a good question. I think the aim is for the first. The reality is probably a mix and probably a bit of the second. I would kind of sort of, I guess, say, look, we can't be perfectionists about this. There are cases where it's very hard to find perfect solutions, and sometimes shifting to something, I mean, it's still better to shift to something that's better than the current solution than to stay and wait until we have a perfect solution. Yeah.
Early on, you were talking about comparing ESG type investments against a kind of standard reference portfolio. And you sort of happily reported that it was weakly positive or neutral. But I'd be interested in what if it wasn't? What if it was negative? Because ultimately, a lot of the investments we've got to make for a sustainable future are not necessarily going to be ones that bring the best returns. So you're making investments for future generations, not for your immediate 3-year or 10-year return portfolio.
Yeah.
So how would you approach this question if there were weakly negative, for example, returns on ESG type investments?
Yeah, well, at first I would say I'm very glad I didn't find that, because it would be a much more difficult conversation. I think there are still reasons you could justify making that investment, and I don't know how the super fund would answer that question because we haven't asked that question because that wasn't what we found. But one argument is, look, it's our duty to maximize returns, absolutely, and that is important. But at the same time, it's not much good for us to deliver absolute maximum returns if it means that our stakeholders are, suffer because of that behavior. So I think that's one line of argument we could look at. I guess the other thing where I think we are exploring and trying to understand more deeply is the fact that as a universal owner of assets, we generally do well when the market does well. And so that means that even though some of our companies might do well by doing things that are ultimately harmful, and have a lot of externalities and are ultimately harmful to the economy, it's not in our interest to allow those companies to do that, or to advocate for it. So I think, you know, that it just being slightly weakly negative, you know, wouldn't create a conflict between our fiduciary duty and our responsibility to deliver maximum returns and our desire to deliver positive social and environmental outcomes.
Yeah, just a wee comment on that. I mean, it would seem to me that as kind of a sovereign wealth fund, there are additional responsibilities on you to look for the long-term future of New Zealand and ultimately the globe. So I suggest this is something you might think about in your discussions with your guardians, because ultimately you will find yourself in a position where you might well be making losses or not so much money by investing in a better future for the world or New Zealand. So I think although you had the relief of finding that it was weakly positive, there will be a point in time where it may not be that the case. So it's worth having those conversations ahead of time to establish maybe a policy around that, and to think about the purpose ultimately of a sovereign fund as opposed to, you know, individual investments.
I think I broadly agree with you. I think those were going to be very long, intense conversations.
I think also sort of on the back of that, this weekly positive relationship is a historical one, right? And a lot of your investment decisions are forward-looking, and you have the luxury, I could say, compared to other fund managers, of a long investment horizon. So your investment decisions should be even more forward-looking. And if most other investors in the market, as I think we can agree, have a shorter horizon, they may not be pricing some of those long-term risks and opportunities, right? So even if you found, say, just neutral or slightly negative, you could still make that argument, and maybe that's the conversation to have around, do we think markets are efficient in terms of long-term risks, or are they mainly pricing short-term risks? If they're mainly pricing short-term risk, maybe our opportunity is actually to take a longer view, which may mean lower performance in the short term, but outperformance even in the long term. Yeah, of course, it could get much worse, and
yeah,
then you have even harder accidents.
And we are very happy to take an investment that's based on a very long-term horizon. We did make that shift in 2016 on climate change, not necessarily because we were seeing an immediate return on climate change, but we said, look, you know, climate change has to be addressed. We believe that ultimately, at some point, the market will address this, well, the market and the government will address this. And so, yes, absolutely. I think, you know, as you say, that's all very fair points. I think at the same time, the cleanest way to solve this is for the government to go and put proper regulations in place that close externalities, put the burden on the right people. There's there will always be a tough tension for a financial firm to take on a loss on behalf of others, and like we are ultimately constrained by our mandate. What the mandate of the government has told us how they want us to invest. So until they come and say, you're now, you know, we now want you to invest in a different way, we have to respect that mandate.
It's the thing in the finance industry, there's a fiduciary duty to maximize the wealth of your clients, right? So, I mean, if you can find a way to do that and deliver positive outcomes, or at least not earn money from negative outcomes, that's great. But then if you don't believe you can do that, then it's almost illegal for you to act in that way.
Yeah, is that, when you say fiduciary duty, is that like a norm within the financial
It's law, yeah.
Yeah.
You have to act in the best interest of the people giving the money. And usually that's interpreted financially. I think I had a question earlier in the class, you know, what about your stakeholder or clients' non-financial interests? So I think there's some work to be done there in the law space, rather than the legal space, rather than my space, potentially your space.
Yeah, and fiduciary duty is interpreted differently in the US and Europe.
Yeah,
I don't know if it's been interpreted in New Zealand yet, but yes, we are. But you know, there's also a very good reason to think that maximizing investor returns should be pretty high on the list of things you prioritize, because ultimately somebody has given you that money. It's not really your money, and they're asking you to do something with it. So you are a steward of their money. Now, I don't think there's anything that's, we come to this weekly positive conclusion. So I think it's perfectly appropriate for us to take to enhance the ESG performance of the portfolio. But if we were trading things off, we would need to think very carefully about it.
Yeah, it's an interesting conversation. Yeah. We could get into that one, but I think I'm going to go to see.
Sure. Any last questions from the online audience? It's your last chance. Nothing yet. So thank you, Lucas, for the webinar, and particularly just for coming down and spending some time with us. I hope you're flying home safe, and thank you everyone for joining online. Be nice to see you in person next time. But that'll do it. Awesome. Thank you, everyone. Thank you.